the way we've been able to push the last couple of years in a bull market that we've been in all assets, whatever you buy today is worth more tomorrow. Now you got to lead the market down the other way. And whatever you sold yesterday, you got to buy for less today. Mm-hmm. And you got to work and lead the market down.
Ladies and gentlemen, welcome to Real Estate Investor MBA. My name is Tejas Gosai, and I've had the honor of helping hundreds of investors achieve the American dream by creating generational wealth through real estate. I've spent the past few years interviewing the most knowledgeable experts I could find in the business to cut your learning time and conquer the hardest subjects in the game. Check out rei.mba, which my team and I have packed with over 75 interviews and free access to our real estate roadmap, webinars, and publications. If you're listening, I am rooting for you, and you're already on your way to financial freedom. Cheers and happy hunting. Our next guest is Greg Dickerson. It took me forever to get this gentleman on our podcast. It is a perfect time to have him on. He is a statistician, genius, brilliant man, looks at everything from a very different lens and gives you a really great perspective. It's an awesome interview. There's one word I love more than million, and it's billion. And Greg's current clients have over $2 billion in assets under management and deals in process. This is somebody you want to take some advice from. It's an honor to have someone like him on our program. So Greg is a serial entrepreneur, real estate developer, coach, and mentor. He has bought, developed, and sold over $250 million in real estate, built and renovated hundreds of custom homes and commercial buildings, developed residential and mixed-use subdivisions, and started 12 different companies from the ground up. Greg currently coaches and mentors some of the top entrepreneurs, real estate investors, and real estate developers around the world, helping them start, grow, and scale their business, raise more capital, and do bigger deals. Greg's current clients have over $2 billion in assets under management and deals in process. Greg is an expert on the topics of entrepreneurship, leadership, and real estate, and is regularly interviewed on some of the top real estate investing and business podcasts today. Greg served in the United States Navy right out of high school and has always been a leader in the community, as well as supporting, advising, and serving on the boards of several churches, ministries, and nonprofit organizations. First, Greg, thank you so much for your service and also being a just well-rounded, amazing human being to the community. I look up to people like Greg, and I take a lot of time to have the best guests on this program. And if you look at some of the past interviews and some of the folks that we've recently had, I am trying to find the best guests that can really give us knowledge that we can apply to what is happening in today's market. I think these are very relevant interviews. Greg talks about the rising interest rates, what's going to happen. I ask for his crystal ball, what we can expect for the future. And it's great. So I love you guys. Thank you for following. Truly an honor. Appreciate it. rei.mba. Check out our roadmap and some of our other information. Hope you enjoy the interview. Cheers. All right, guys, you heard the great intro. We have Greg Dickerson here. Greg, thanks for being here.
Hey, thanks for having me. Pleasure to be here.
For sure. Rather than waiting a minute, let's get right into the heavy stuff. You're a very knowledgeable guy. You've made it through some crazy cycles and you have some amazing transferable skills. First, thank you for your service.
Yeah, thank you.
Thanks for keeping us free, able to invest in real estate. And right now, people are just kind of going nuts with things. If we could just kind of talk about today and some of the things you've historically learned to deal with times like now.
Yeah. So very interesting times. You know, a lot of people that are in the game now weren't around in 2008 and 9. And I was a real estate developer, hot and heavy in 2008 and 9, early mid career. I started my journey in 1997. So, I was about halfway through my building cycle then, had $40 million worth of development loans that I just finished on some product and was working the permanent financing on the back end. And the banks they weren't there. I had all these permanent commitments, year, 18 months prior to starting all these projects, finished them out, went to get the permanent financing, and, nobody was answering the phone on the other end. So that was a very interesting time. And, I didn't understand the banks and how they were doing things in terms of the, credit default or not credit default swaps, but the MBOs and CDOs and all these different things, mortgage-backed securities and, the commercial derivatives and all the things that were going on, the way they were carving properties up, packaging them and selling them. So I didn't really understand how the banks work and what was going on, but it was really interesting. I had all of those projects that were being completed. Then the market started changing. Interest rates started going up, which, I kind of knew 0405 was the peak of the market. And then things that started coming back in 0809 just caught everybody by surprise in terms of, the real estate market. But what was really interesting during that time was what the banks did and how they handled things. And they weren't cooperative at all. Banks weren't willing to work stuff out. They didn't want to cooperate. They were just trying to get properties in and get them off their books. And what we all didn't know was going on behind the scenes was you had the government, bailing everybody out, making those deals behind the scenes, making all of these lenders whole. And then of course the derivatives and the mortgage-backed securities and all those things, commercials, CMBS, all that stuff, very complicated structures and difficult to unwind in a situation like we were facing. So, like I said, a lot of people have never been through something like this and, don't really understand what's in front of us and where things can go, even though this time is very different than last time. The banks learned big lessons, very different real estate market right now in residential, but commercial. It's going to be really interesting to see how the commercial market reacts and how things are affected. The banks are much healthier, but banks are also pulling out on certain markets. I think it was Bank of America that let out a report the other day. They're not lending on office or commercial anymore right now.
Is that nationally?
Yeah, they're pulling out of that. So they're not funding development or acquisition in, for office or for retail. And it's kind of broad right now because they're kind of seeing the writings on the wall in those sectors. And with the worries of recession and things like that, with interest rates going up like they are, I mean, the Fed yesterday came out. I don't know when this is going to air, but the 21st, is when the Fed had their decision and raised 75 basis points. But what they said was, we're going to go higher than you think, longer than you think, and we're not going back to zero ever. What the Fed says, we're going to keep 1% above inflation. So what the Fed told you yesterday, and the reason the markets are reacting like they are, and the reason bonds yields are going up and rates are going up, is because the Fed said, we're going to be 100 basis points above inflation. So most of us know inflation is not going to come down to 4 or 5% for probably a year or two. That means the Fed funds rate is going to be 5-6%. Well, we targeted 4.5%, this year. They said, into the end of 2024, but they basically said, we're not ever going back to zero.
Scary.
It is. And so what that's doing and what the bond market's doing is putting severe pressure on the commercial credit market. So you're going to see credit tightening in commercial, conduit loans, bridge debt, Freddie and Fannie. You're going to see debt, continue to tighten. You're going to see, lower LTVs, LTCs. You're going to see more reserve requirements. You're going to see more stringent underwriting on assets in certain markets. So they're going to start looking at markets now a lot closer. They're going to start looking at assets in those markets a lot closer, and they're going to really start digging into the sponsor. So things are going to get difficult. And the reason is because now investors that were funding, MBS and CMBS and those things are looking at treasuries at 4 and 5%, risk-free trade. So a lot of capital is going to go into those assets versus going into the real estate market. And with recession fears and with the things that the Federal Reserve came out and said yesterday, it's putting a lot of caution in front of a lot of the banks, a lot of the lenders, life companies, sovereign wealth funds, debt funds, that would typically fund commercial real estate. So very interesting times ahead of us. As you know, markets changing, cap rates are adjusting, and things are getting a little bit more difficult.
Yeah, everything you just said. I got, we need the transcript. That's perfect on how it's going. But there's always some, what do they say about in chaos, there are ladders. And, there's ways that people like you know how to maneuver, right? To get around that. And your expertise, I guess, in now why banks are the way they are. How do you tell someone who's thinking about getting into real estate that, you can still do it? Or is it just a bad time? What do you say?
Yeah. So number one, you got to be an expert. You need to educate yourself, understand every market's different. Real estate's hyper local. Every market's different at the state, city, area of that city, street, position on that street, and then by asset type in those specific areas. So there's a lot of nuances to real estate. markets will adjust. Sometimes real estate, residential is a lot slower to adjust than commercial. Commercial can and will adjust a lot faster. So you just need to be in tune with what's going on. You need to understand what drives a deal in real estate, what drives value, the debt and the cost of that debt, right? Capital and the cost of that capital. So equity capital and then debt. Those are the two things that create and drive real estate deals and also the outcome of those deals. So the way we've been able to push the last couple of years in a bull market that we've been in all assets, whatever you buy today is worth more tomorrow. Now you got to lead the market down the other way. And whatever you sold yesterday, you got to buy for less today. Mm-hmm. And you got to work and lead the market down as the market continues to adjust. You need to be very conservative in your underwriting. You need to be very conservative in your assumptions. You need to assume whatever you're buying now is going to be worth less potentially. For a little while. Markets are cyclical, peaks and valleys. So, once the dust settles and we get through these times and we get geopolitical issues resolved, we get banking issues resolved, we get, the Fed resolved and what they're doing, then we can be back off to the races again. But they said, we're never going to be back to where we were. So what you need to understand and what the Fed said yesterday, again, they don't have a whole lot of credibility right now because they've been very weak on inflation and they've been very wrong in their predictions. But what they said yesterday was we're never going back to where we were. So a lot of people, all they know is the last few years, but the last 10 years where we had record low interest rates that we've never seen before 2008, right? I mean, what was the lowest we saw back then? Like 4%, 4.5%. So where we are now is like really good in terms of general rate. And what inflated these values over the last number of years was zero interest rates. And that's what a lot of people don't understand in this market right now. That, there was no other yield for investors. And that's what investors are after. I'm talking about life companies, sovereign wealth funds, debt funds, hedge funds that are funding CMBS, MBS, and, Freddie and Fannie, or Fannie and Freddie. I keep saying Franny. I got a good friend whose wife's named Franny.
I was going to say Fran Drescher.
Yeah. So, that capital has been chasing yield and there was no yield anywhere else except risk assets. So that's why risk assets, crypto, stock market, real estate, boom, all through the roof. Now you can get yield in the treasury markets. You can get yield in the bond markets. So, that's where a lot of that capital is going to be going right now, which is going to make it more expensive, for commercial debt and more restrictive, for that commercial debt. So, very interesting. But that's where the opportunities are created. Right. So there'll be opportunities, educate yourself, understand what you can do, where banks are, what they're willing to do. You can take deals over just assuming the debt. You might be able to, take deals over by providing a little bit of capital. You might be able to take deals over just using your balance sheet, outright cash deals when, banks towards the end of this year, if they've got some distressed debt, they're going to be looking to unload it. If they've got assets that they are in default, they're going to want to unload them before the end of the year so they can reset going into the next year. So there's going to be a lot of deals coming through this year, but I think the big opportunity is going to be next year once we really start to see where the economy is going and the effects of what the Fed's doing, potential slowdown in the economy. As we get into 2024, that's where you might see some real opportunities, but there's opportunities in every environment. You just got to make sure that you price them differently. You understand the values that we saw over the last couple of years, we may never get back to again. So these cap rates that we saw, we may never get back to those again. When you're measuring that against risk-free assets and, your buy signal's the Fed. So once the Fed stops and once inflation is down and the all clear signal's been given, then, we can start putting in a bottom and then eventually they might start reducing, but they're only going to reduce to a certain level. So you just need to understand what they're saying at the time, where that is, and then price based on that so that you're, not putting yourself out there in terms of thinking we're just going to have this exponential boom again, because they're saying they're not going to do that. The other thing that was interesting that they said yesterday was that they're not selling MBS yet. So that was really interesting. They're guarding the real estate market. They know what will happen if they start rolling MBS off the balance sheet. That would destroy the real estate market. So it's good to know that they want to see correction, but they don't want to destroy it completely.
It's so neat to hear the way you're laying it out. In 2023, 2024, a lot of people don't like to talk about that part of the future, but you mentioned geopolitical unrest and some of those things. I've been hearing it too, because in our area, right, that we're very close with the bankers and tightening up is scary. Getting out of this one day is also not going to be an easy thing, right? This is a very large change that's happening. it's just going to be harder and harder until 2025, because we need a president, and it's just going to be pure chaos for a bit.
Yeah, yeah. We've got, the whole election cycle coming up. Midterms, they're kind of, they're kind of done for at this point because of inflation. But the real, 2024 election cycle is going to be where you're going to see some interesting, that's where it's going to get interesting, where political pressure will be put on the Fed and Treasury to do some things. So it'll be fun to watch that. The big thing right now is we have so much unprecedented stuff going on out there in the housing market. We've never seen record low inventories while demand destruction is happening. And rates are not quite there yet, but they're getting ready to. Once they cross 7%, I mean, they're shooting up, 6.5, 6.6 or something today.
Yeah.
So, that's putting a lot of pressure on the housing market, but there's still a lot of pockets that are unfazed. So we've never seen that before. We've got a very healthy borrower in residential real estate. Record low levels that they've locked themselves into as far as interest rates go. 70% of loans, I think, are sub 4%, 30 years. Another 10% or sub 3% for 30 years. So you have people that are locked into their houses because of that. And then, where your biggest risk and your biggest exposure is in the commercial market, more specifically in the multifamily market, because a lot of these deals that were done over the last couple of years at, 2, 3 forecasts with bridge debt, that's coming due. So that's what I'm talking about, where your opportunity is going to come from. Wherever you've seen these, interest-only loans that were short-term, that were done for, 3 years, 5 years, they have to re-up. They're not going to be able to. They're not going to be able to get out of that because the values are gone. We've seen record rent increases, so that's kind of helped offset a little bit. But cap rates are going up. So a lot of these assumptions that a lot of these deals were done by, just aren't going to be able to work out at the end. So those deals may be ripe to be taken over, and that's going to wipe out all the equity investors in those deals. When you take something over like that, so that's what happens. When a deal goes to a bank and it's under stress and somebody takes it over, equity gets wiped out and you're taking it over for the debt. And there's a lot of big funds out there on the sideline that are raising cash for distressed debt, corporate and in commercial real estate.
So help me bring this point out for a second. You mentioned the area, the street, the block, the neighborhood. Cap rates can be negligible sometimes with, looking at the right street and block. And if you have some other properties there, things like that. And you don't need, when you're a new investor, even if you're somewhat seasoned, you're not looking for 50 properties. You need 1 win or 2 wins. And that's, that takes a little bit of time to be able to do it. So, I kind of want to stress, you'll still get the deal. It's just a lot more work, and underwriting is difficult already. Underwriting further to, you're going to lose deals now because you can't go high enough and things like that. Right?
Yeah,
What changes?
There's been a lot of competition, a lot of pressure on cap rates. And again, because the institutional money, we're looking for yield and chasing those deals. So, and then you have the syndicators. And, over the last couple of years, we've seen a lot of people just get into, especially multifamily, but other assets as well, and equity. So, equity capital funds, same thing, chasing yield, chasing deals. And, they're borrowing money to go, buy up and roll up assets like self-storage or car washes or, whatever, and then turn around, package them and flip them to another fund. So that yield is shrinking as rates are going up in other areas, as cap rates expand, interest rates expand. It's all about the cost of capital. So at the end of the day, the only assumptions that you can make are, well, I can increase rents another 20, 30% because that's what they went, the last couple of years. That's not going to happen. So we're reaching critical mass in rents. That's the other thing you have to look out for, especially residential. So multifamily, mixed use properties, we've seen rents go up 30, 40% over the last couple of years. That's what everybody was ignoring in the inflation numbers. We've all been screaming about it, going, these inflation numbers that they're reporting are not correct because rents are lagging in their numbers. Now they're starting to hit the inflation numbers. They're sticking. Rents aren't coming down. They're continuing to go up because these deals are getting done. That's the only way they're going to work. So when this comes to fruition and they have to re-up and they can't, the only thing they can do is raise rents to kind of carry the asset as long as they can. Yeah. But at some point, people they can only afford what they can afford, so they quit paying or they move. And there will be pushback at some point. And there already is in some markets. That's why I say every market's different. You go into some markets in Florida where rents have increased so much on multifamily and housing, people are moving. There's a lot of area that you can move into in Florida that's close to where you need to be, but far enough away where it's cheap. And, we saw this in 08, 09. If you remember in 08, 09, everybody wanted to be in the cities and everything close into the cities like, Philadelphia area, DC area, big metros. Real estate spiked exponentially close in. When the recession hit, everybody moved out to the suburbs because it was
Yep.
cheap. Gas prices did that. When gas prices were through the roof, what was that, 2014, 15, somewhere around there, everybody started moving closer in. So it drove real estate prices close to the cities because of the commute. And then that reversed in the pandemic. So, real estate's a funny thing. That's why I say it's state, city, neighborhood, block, street, and position on that street. A cap rate can change right around the corner, depending on what's going on with that asset, that geography, schools, crime, all the different things. And then, now with rents where they've gone, that's causing people to have to move. So it'll be interesting to see how far that goes. I mean, typically it's been 30% of income, allocated towards housing costs. I mean, we're pushing 50% in a lot of areas, and that's putting a lot of stress on people, which reverberates through the economy. You have real estate slowing down, transactions,
Sure.
mortgage brokers struggling, real estate brokers struggling, and everybody else that's party to those transactions. You have the construction industry that's contracting, So, I mean, all of these things are going to put pressure on the overall economy, but it takes time. So this isn't doom and gloom. This is just, these are the things that are playing out in real time in front of us. And if you look at the markets, you can see how they're kind of slowly reacting and kind of unwinding into this. And if you go back and look at 2009, you see the exact same thing until the banks collapsed, and then bam, you had that final drop. Then the government stepped in and started propping companies up, started, buying distressed debt and assets off the books of the banks that were in distress and foreclosure. And, literally buying stock and propping companies up and then dropping rates and, doing everything that they did. We had no inflation. So they could do it. So we never fully worked the system and let everything reset without intervention. Go back to 2001, dot-com bubble, same kind of thing. Everything super bubble peak. And then, things kind of started rolling over the cliff a little bit, and all the indices and, as the economy repriced. This go around right now with inflation where it's at, the Fed can't intervene. Yeah, they might be able to do some things with, maybe some foreclosures and, a couple of companies, we've seen them, bail out airlines and things like that, but they're not going to be able to come in and drop rates back to zero. They're not going to be starting QE again because can't, inflation will do more damage to the economy than the market collapsing. And it'll also create serious civil unrest. And when you look around the world of what's going on right now, you see people marching in the streets and taking over, overthrowing. I'm not saying that can happen in this country, right, as far as overthrowing the government, but people will take to the streets if they can't feed their families, if they can't afford shelter. That will create mass protests, and then people will just stop paying like they did in China. You'll see that. Other countries, you're seeing actual regime changes where people are trying to overthrow the government. So Iran's erupting right now. We saw Venezuela. We saw, a couple of these other countries, where these things are happening in real time right now. So it's very polarizing times around the world right now.
I mean, this goes right back to what we were talking about at the beginning of this, banking changing and getting ahead of it, right? This is I don't like to say it's a fearful time, but it's an overly educate yourself time.
Yeah, it's a time to just really, so, I'm an optimist, right? I'm opportunistic. I've started a dozen companies, built them up, sold them off. I've done, hundreds of millions of dollars in real estate. I'm a developer, so I take a lot of risk, and I'm used to, big risk, big reward. But there's also times where you have to be cautious. You have to be cautiously optimistic, and you have to just risk off. So we're just in a risk off environment right now. So sometimes, just like 2008, 9, you have to let the dust settle. And, this is all positive, by the way. I'm just laying things out that you need to be aware of and understand, because the opportunities are going to come just like they did back then. So I was put out of business as a builder in 2008, 9, because nobody was building. I was on the Outer Banks of North Carolina. Nobody was doing anything. And, but I pivoted. So instead of being a builder where I'd build a house for you, I started building little spec houses and selling. And that was still working because they were expensive. People could pay cash. A lot of people still had cash during that time. So I made a little business doing that, and then opened some restaurants, and I did some other things and took advantage of, opportunities. Restaurants were closing after 2008 and 9. So, space was abundant. So I could walk in, take over restaurants with no money, get them up and running very quickly with little investment. Those were great little opportunities. Same thing in real estate. Instead of building multi-million-dollar houses, I started building little, $100,000, $200,000, $300,000 beach houses and selling those. And then I jumped into the markets for the first time in the bottom of 2009. I was fortunate enough to have a friend that worked on Wall Street prior to moving to the Outer Banks. And he's like, man, he said, this is generational opportunities in the market right now. He said, this move right here will put your kids through college. So that's the first, time I entered the markets right at the bottom of 2009 when the Dow was at 6,000, S&P was 600. And, people thought I was crazy, or maybe it was 3,300. I can't remember. I'd have to go back and look what the lows were. Yeah, I meant like 6,000 and 600.
That makes you hard.
Yeah. So, I'm not afraid to take risk at the right time. So this is what I'm saying. We're still at the beginning. So if things play out, this is the beginning of a bear market. We haven't even seen, where things can go. And we're kind of where we were in that beginning cycle of 08, 09, and where we were in the beginnings of the dot-com 2000, 2001. And it's just cycle. It's just business.
Yeah. And I think that's the most important message of this whole podcast. There's somebody like Greg who has made it through a bunch of these things. And the way you talk about this matrix, it's just very neat to hear. But you make yourself available to people. How does someone get a hold of you to talk to you?
Yeah. GregDickerson.com. So, I don't do consultations, but, I do coaching and mentorship, but that's a formal program that's on my website. But it's GregDickerson.com is where all my info is. I do have courses on real estate and entrepreneurship and other things. I do have coaching and mentorship, but I have a YouTube channel that I'm putting out content and videos every day as
Love
well.
It.
So that's where you can get what I'm looking at, what I'm thinking, how I'm viewing, what's going on right now. And I put it in context of my experience in 2008 and 9, because it's very relevant right now, what's going on as it was back then, not from a banking crisis standpoint, from how the banks are going to react. Because everything I'm saying, if you went behind the scenes and sat, at the board meetings of the banks, loan committees, this is what they're talking about. When they're looking at your loan, they're going, all right, now wait a minute, we've got this going on in this neighborhood over here. These things are happening. The economy's doing this. The Fed's raising rates. That's how they're sizing loans and measuring risk, because that's what they do. That's what loan committees do. 3 months ago, it didn't matter because the Fed's going to jump in. They're going to backstop us. They're going to take, they are our net. Now, Fed's gone. They're out of the game. They're not buying anything. They're not pumping any money in anything, and they're not dropping rate. They're not going to pivot. So those are the conversations. And I'm hearing it real time from my clients that I'm working with all around the country that are, trying to secure debt for acquisitions right now. Banks are changing in real time quickly, where, the other day they were doing 80% LTC. Now they're doing 60, and they were looking for, 12 months reserves were looking for 18. But, same thing happened in the pandemic. Lenders tightened and till they understood what was going on. So it's just how it works. The key is every bank's different. Every loan committee is different. Every underwriter is different at those lending institutions. So this is when you got to really start broadening your net and talking to everybody. And that's where you can really gauge it. And that's what I love about banks. A lot of people hate banks. I love them because they are a great gauge of what the economy in real time looks like, because they're basing their decisions on credit that they're issuing to their businesses, their business clients, and their banking clients, like commercial credit, business lines, things like that. So they know what default rates look like there, what kind of pressure that the general public is under or not. And they're also looking at, their loans and how they're performing, things like that. So they've got a real pulse of what's going on, local and regional banks in these areas. The bigger banks, a little bit different, and they're more like Fed reactive kind of banks. But, talking to local and regional banks, you can get a lot of insight to what's going on in real time in the economy, because that's who they're talking to out in the streets, and businesses and consumers. And, they understand, when real stress is showing up in the real estate market.
That's probably the best nugget homework for everybody. It's a time when you need to do it and then put it in motion. And bankers are available.
With REO department, special assets managers. That's what they're called at the banks, special assets managers and REO department. And start having a regular follow-up with them. Go to lunch, whatever, call them on the phone and just, see what's going on out there, what their loans look like and what they're seeing. That's where you're going to get the first opportunities as well as the first indications of what the market's really doing.
Love it, Greg. You're amazing. I got one last question. How did the Navy help you in real estate, get through a bunch of this stuff? What's something specific?
Yeah. So I went in the Navy right out of high school, did not go to college. So first of all, discipline, standard operating procedures, chain of command systems, all of those things, but discipline more than anything else. Discipline meaning doing what you need to do, no matter how you feel about it, whatever it takes, you get the job done. So that's discipline. You just do it. There is no other option. Failure is not an option. You just go. So that's number one. Number two, systems, standard operating procedures, preventative maintenance, so taking care of things so that the things will take care of you. And that's your business. You take care of your business will take care of you. Take care of the people in your business, they will take care of the business for you. Take care of your customers, everything else is going to work itself out. So, those types of things. I did get some retail training. I did retail in the Navy, so I did get some business training, accounting, and things like that. But those were the lessons that I learned for my time, and then just had a blast seeing the world.
Yeah, I bet. It's really, really amazing. Wish we had some more time. But Greg, your knowledge is just fantastic. Thank you for sharing here.
Yeah, absolutely. Let me know if you want me to come back, and maybe we can talk about some real estate development. We didn't even get into that today.
Yeah, no, it's just so timely. I would love to have you back. And here, guys, look at the show notes, contact Greg, go through his stuff, and we'll have you back. But really appreciate it.
Thanks for having me.
All right, it's Real Estate Investor MBA, rei.mba. Thanks so much. Cheers.